Hello, everyone, and welcome back. A lot of people are interested in trading, but they don't know where to start. So I decided to create a new series of videos that will help new traders understand different charts and patterns. And today we're going to be talking about the candlestick chart. We're going to be dividing the candlestick chart into three different videos. The first one, we're going to be talking about the theory, we're going to be talking about the structure of the candle, and the different types of candles. Second one, we're going to be talking about reversal patterns, and the third one, we're going to be talking about continuation patterns. So let's start with some theory. So in the 1700s, in Japan, a man called Homa, he was actually watching the rice market, and he noticed the link between the price and the supply and demand. But he also noticed how the market is actually strongly influenced by the emotions of the traders. So basically, this is what candlestick chart comes to help us through. It basically represents these emotions of the buyers and sellers on the chart, and it also helps us forecast and predict short-term movement in price. So there are three different types of candlesticks. The first one is called a bullish candle, which basically represent the market going up. Second one is called a bearish candle. It represents the market going down. The third one is called a doji, which basically represents that neither the buyers or the sellers have the power to actually move the market. So let's start with the bullish candle and let's talk about the structure of this candle. So here is a bullish candle. So this rectangle right here is called the real body. So you gotta understand, when we're talking about candles, it usually refers to a specific frame time. So basically, let's say we're talking about a 1 day chart or 1 hour chart. So one candle represents 1 hour on a 1 hour chart. So two candles, that will be 2 hours. So let's say the market actually opens here at $1. In a bullish candle, the market is going up. So it opened here at $1, then the market started moving up and down in that specific time. So in that 1 hour, the market went up and closed here. So always the bullish candle, the open price starts in the bottom and the close starts ends at the top. We have a second part of the structure, which is called the shadow or wick or tail. It's up to you what you want to call it. So this basically represents how much did the market actually pushed, but he wasn't able to close. Now, what do I mean by that? So let's say, like I said, the market opened here at $1, and the market moved up all the way to $50 and reached here, but the market wasn't able to close at $50, so it dropped all the way back here to $40, and that's where the hour ended. So this shadow represents how much the price actually went up and down, but it doesn't represent when the market actually closed at that hour. And that's basically it. That's all you need to know about the bullish candle. Now, the bearish candle right here is basically the same, but one major difference between the bullish and the bearish. So it represents the market going down. Okay, so from the top to the bottom. So the open price will be on the top. So right here. So let's say the market opened here at $1, it went down to $50, and it went back up to $40. That's all you gotta know about the bearish candle. Now let's talk about the doji. Okay, so there are five. Yeah, there are five different types of doji candlestick. The first one is called a normal doji. Okay, so it usually represents the market is indecisive, so it wasn't able to go up or down. So it just usually looks like a cross. The second type is called a long leg doji. It's the same as the normal doji, but the long leg basically represents how the market actually moved up very far and down very far. But at the end of that specific period of time, it wasn't able to close above or below when it opened. So basically, this horizontal line represents the opening price and the closing price. So let's say we're talking about an example. The market opened at $1, it went all the way to $50, then it went back to $1 at the end of that hour. So the third type is called the Dragonfly Doji. Now, a Dragonfly Doji is a reversal sign. So you usually see this pattern at the end of an uptrend or at the end of a downtrend, and it represents a reversal. So if the trend is going up and you see this doji, Dragonfly Doji, it means that the market will probably go down after this doji. The fourth type is called the Gravestone Doji, which is basically the reverse of Dragonfly Doji. It's the opposite of that. It usually means that the market is going up. It's a continuation pattern. So if we have an uptrend and we see the Gravestone Doji right here, that means that the market is going to keep going up. And the last type is called a four price doji. Basically, this means you rarely see this pattern. This basically means that the market isn't really trending. There's no buyers or sellers. And that's everything you need to know about candlestick theory and structure. Now, I'm going to show you an example, and you can see this live. So let me go here, templates, let's go this one. Okay. So here's a chart about the Bitcoin price versus the US dollar. And this is a 1 day chart. So basically each candle represents 1 day. So as you can see here, green candle represents a bullish market. The market is going up. A red candle represents a bearish candle. It represents that market is going down. Now, as you can see here, we have a doji here. We have a doji here. We have a doji here. So it's basically like that. It's very simple. And like you see here, there's like the wicks, how the market actually pushed up and pushed down. So like the market right here, it was at 35,000, then it pushed up all the way to 39,000, but it closed at 37,000. And that's basically it. In the next video, I'm going to be talking about reversal patterns. Basically, so when the market is going up, for instance, like here, let me show you here. Let me grab my brush. Look at here. This of that. Okay, so watch this here. For instance, a reversal pattern, the market was going up, then it reversed and went down. The market was going down, then it reversed and it went back up. That's it for today. I hope you learned something. Please hit the like and subscribe button. I'll see you guys next time.